Right, good evening, everyone. Thanks for your patience. Sorry we're running a few minutes late on starting. We just had a few technical errors, last-minute technical errors to deal with, of course, because that is Zoom. Anyway, welcome, everyone. It's great to see some of you joining the call, and welcome to our sixth quarterly economic update, brought to you in collaboration with Investec. I believe that every time that Sarah has hosted one of these before, she said that this is a very timely time to be doing this. But so once again, this is very timely because we live in, as it were, timely times. Over the course of the next hour, you're going to get an update on the overall economic picture currently, and then we're going to get down into the weeds a little on the financial markets and specifics around investment. But before that, just a brief word about us. To those of you that don't know me, hello, I'm Simon Hopkins. I am co-founder of Angel Academy, and I'm joined this evening by my co-founder, Sarah Turner, and our network manager, Michelle McQueen. So just a very brief word about us. So we set up Angel Academy something like 8 or 9 years ago now. We are a network of mostly women investors, and we invest exclusively in women-founded or co-founded businesses, almost exclusively in the technology and science space. And since 2014, we've invested in 45 women-founded businesses. We were created very much with women in mind. As I said, we are, as an investor group, we are something like 70% women. Sarah often jokes that her diversity target is 30% male. So I'm glad that for once I'm ticking a diversity target box. So our goal is twofold, really, to address the investor gender gap. And of course, by doing so, we hope to release more capital to women-founded businesses. Our offer is really based on depth of experience and expertise at this point. We have, over the course of nearly a decade now, seen quite literally thousands of presentations and met with and heard from, again, literally thousands of founders in that time. We run a very rigorous, but we hope very transparent process for both founders and investors. And our investors themselves are often entrepreneurs, some of them indeed exited founders, and others in the group are senior leaders in a whole range of professional spheres. So it really is a diverse and extremely experienced group. We were proud last year to be listed by Bowhurst as one of the UK's leading investor networks. And apparently one of the youngest. I believe by that it means one that's not been around as long as the others. I'm not sure it refers to the age of individuals within the group, certainly not to me. But we're also proud that we were the only women-focused group in Bowhurst's list. But anyway, that's enough about us. I do want to move on quickly tonight because we've got an awful lot to cover. This evening, we're going to hear first from Sandra, who's going to give us an overview of the current economic situation. And then we're going to pass on to John, who, as I said earlier, is going to look at some of the specific issues in the markets. I think those of you that have been on these calls before will know that we want this to be as interactive as possible. So please put your questions to us in chat. And we'll endeavour to get through as many of the questions as we can. So I think with that brief introduction, I'm going to ask Sandra to come to the virtual stage. Sandra, are you there?
I am indeed.
You are, great. Okay, we're getting over our technical. I was going to use the word grimble. I just made up a word. Our technical grimbles. Do you want to try and share your deck with us?
I shall. Here we go. Hopefully that is all working as it should.
Let's Yes, it's all working. Great stuff. Over to you, Sandra.
Wonderful. Thank you very much for inviting me again to give a bit of an overview of where we stand now on the economic outlook. If you look back at 2022, it's fair to say that that was yet again the year of inflation. We had 2 years of surging inflation now, and as we all know, this is very visible across all the major developed countries. So the US, the UK, the Eurozone all experienced multi-decade highs in inflation last year. We had discussed on previous occasions what is behind that. And clearly one of the factors that was at play was COVID and the demand surge, especially for goods, coupled with supply chain disruptions that were behind there. Then we had, of course, the extra impact that came on top of that from the war in Ukraine, and especially the energy price surge that we had behind that. But it's not just that. Core inflation as well, which means inflation excluding food and excluding energy, it's also far above target in these jurisdictions. As my slide shows, this is what is shown in the dotted lines. And that's the bit that is of most concern to central banks. Now, we did have some better news if you look at the US inflation trend in the last few months. Markets have taken hope from the fact that there has been a decline, in particular in headline inflation. So overall inflation in the United States, which is the solid gray line. So yes, the picture has improved a little bit, but it's certainly far from satisfactory if you consider that the inflation target is 2%. In all these areas. What has the response been? Well, certainly as we entered this period of high inflation, initially the hope was that inflation was transitory. That was a phrase that was used very widely by policymakers. So the sort of initial reassurance was these special factors that were behind this would go away, inflation would come back down of its own accord. That story died very quickly. It ended about a year ago, slightly more than that, when instead central banks moved into a different mode, getting more concerned that we're getting into a more entrenched inflation situation, in particular because we're seeing more of a spillover into the labor market, where inflation, labor markets are very tight, unemployment is very low. So against the backdrop of higher inflation, even if it is due for shocks, the risk of wage increases being granted was much higher. So something had to be done. The something, of course, meant for central banks interest rate hikes. And we've seen very steep increases in policy rates. Now, what I've shown in this particular slide is how the UK policy rate has evolved in the current cycle. So that's a sort of very dark black-blue line, relative to previous tightening cycles. All of these are the tightening cycles that we've experienced here in the UK since the central bank started targeting inflation. And as we've seen, what we have had by way of the change in rates over this period cumulatively since the tightening started has been very rapid, far more rapid than what we'd seen on previous occasions. Although it has to be said, we are starting from a much lower base than in almost all the tightening cycles. So cumulatively, we are sort of now heading towards what's the ballpark of sort of the past peaks of interest rates, but starting from a very different point. Of course, it hasn't just been short-term interest rates, policy rates that have moved. But this sort of change of view on where inflation is heading has had repercussions all along the yield curve. So interest rates for longer dated maturities have also moved up very sharply. Last year really has been quite an experience, as we all know, in the UK, as far as the interest rate picture is concerned. We've had a massive repricing. I've plotted a few dates of where yield curves were at various points of time sometime last year. So we started the year, this light purple line, very low interest rates expected to persist as much as 30 years out. this had moved already with the higher inflation backdrop. There was already some repricing. So the orange line that showed just before the invasion of Ukraine, there was already an increase, but we are still in a fairly low interest rate environment by historical standards. With the invasion of Ukraine, and in particular with the energy shock that this brought about, the overall market conditions changed quite drastically. So by the time that we got to Boris Johnson's resignation, we already had much higher rates. As Liz Truss came in, they had moved higher still. Of course, then there was the exceptional period of volatility in UK gilt markets that the mini budget brought about, and then the Bank of England intervention has pulled yields back down, and again successfully. We have moved lower still since the Bank of England intervention, aren't quite back to where we were when Liz Truss was appointed, but sort of in that sort of region. Obviously, if we look at interest rates that are not only high now in the short term, but persistently expected to be high for a long period out, that has big implications for valuations for all sorts of asset classes. And that's something that John will touch on shortly. Of course, a key lesson that the government has certainly learned in this experience is that fiscal discipline is something that you can't just put off into the indefinite future. And so therefore, sound fiscal policy is something that will have to be a feature of policymaking going forward. Now, I've got some good news. After this very rapid move that we had in energy markets, actually most recently the picture has improved quite considerably. In this slide here, I've tried to show what has happened on gas markets. And this is natural gas prices as faced in the UK, which of course is very dependent on what is happening in Europe in general, because there's a great deal of integration between natural gas in the UK and in continental Europe. And overall, the dates that I have shown here are those that were the meeting dates of the Bank of England, and when they put together new staff projections, which are their own forecasts for inflation and for interest rates. And as you can see, the latest line, again, sort of dark blue, black line, is more or less the sort of picture that we faced around May time. And that was just before Russia cut off supplies to Germany through the Nord Stream 1 pipeline, which had triggered then a huge spike in gas price futures thereafter. And so the situation is considerably better, and the outlook is, in the expectation of markets, considerably better than it was. We do have to say that this was helped by a mild early part of the winter, which has helped storage in the European space. It has also been helped by generally very successful procurement of LNG in Europe. And that had something to do with China, because we were a beneficiary of China's net zero policy, in the sense that a lot of the LNG that China was supposed to receive contractually has been rediverted to Europe and has helped to fill these gas storage facilities in Europe when they were most needed in the current period. So this, of course, could change. So markets have repriced a long way, but there is still the caveat that there's no guarantee that we really are in a sustainably better position, because it could be that there's much less LNG available on the market when it comes to refilling gas storage for next winter. So a repeat isn't fully out of the question as far as the gas price spikes are concerned. Still, for the time being, it's good news. What does it mean for consumers? Well, consumers, of course, never felt the entire impact of the gas price spike to begin with, because in the UK, certainly we had government intervention. The government intervention came in form of the energy price guarantee, so a certain cap on the unit price of energy that consumers are being charged. Had it not been for this cap, we would have had far higher utility bills than we already have. Even with the guarantee, of course, we have had a near doubling in household utility bills on a per unit basis. Without that, right now, we would have had a 235% increase in energy prices. So yes, the government has protected households to a considerable degree, which has been very costly, but it certainly hasn't fully offset the shock to energy bills that we're seeing. The good news of the fact that energy futures are now suggesting that prices will ease considerably going forward means that our utility analysts think by the second half of this year, we could actually get to a level where the market price of energy is lower than the energy price guarantee level. So this is sort of dots on the dark gray line. So we could actually be faced with household energy bills being slightly lower than £2,500, which is the current energy price guarantee level, which is in itself supposed to rise to £3,000. So the government might not actually need to subsidize household energy bills after all in the second half of the year onwards, which would clearly be very welcome news as far as public finances is concerned. It would also be something that would be supportive as far as the energy picture is concerned. Indeed, with these sort of big swings in energy prices, we could move from a situation where instead of utility bills adding substantially to inflation, currently they explain about 3.1 percentage points of the total inflation rate, that contribution could actually turn negative by the fourth quarter of this year. So disinflation from energy bills is coming if energy prices stay where they are, which is of course a big if. The other good piece of news is that we had already seen through last year considerable improvement in supply chains. That was the sort of early COVID stage when it was impossible for companies to produce as easily abroad and to ship as easily from abroad in overall supply chains, which contributed a lot to not only difficulties for businesses, but also pushed up prices for everybody. Especially now that China has abandoned its zero COVID strategy and done so much more decisively and much sooner than we thought. We expected this to come sometime this year, but perhaps more gradually. Instead, of course, it's come overnight and very abruptly. With that, the chances of a further easing in supply chain pressure has certainly increased. And that's good news from our point of view as importers of Chinese goods, because it means perhaps further downward pressure on goods price inflation. So another perhaps transitory effect is now indeed coming to pass. That doesn't mean to say that supply chains will fully necessarily go back to where they were. I think a lot of companies are reconsidering whether the sort of just-in-time model that they had beforehand is sufficiently robust in situations such to disruptions. So just in case production may be more of a consideration, that means perhaps more nearshoring, more onshoring, so deglobalization in a way, and that is a costly strategy of its own kind. So perhaps there will be more price pressures coming from goods prices. We won't go back fully to where we were, but certainly to not have the constraints of zero COVID in China is a positive thing. All of that has to be put against the context of the labor market. I mentioned that is the part that central banks have been most concerned about, and that is really the part that is most directly under their control. So we have had a very low unemployment rate historically in all the major countries. And that is one part of the story of why labor markets are very tight. Another part is that the participation rate, so the number of people who are either employed or unemployed, so they're actually looking for a job or have one, has in some cases taken a big knock during the pandemic. And if we look at the major regions, that sort of participation rate of people who actually want to look for a job, if they don't happen to have one already, hasn't recovered fully in the US, and certainly not in the UK. It has, however, in the euro area. Now, this is a strange situation because usually at a time when unemployment is very low, so jobs are easy to find, people are encouraged who may not have been looking for a job previously to restart the job search. That the fact that they haven't, even though inflation pressures and cost of living pressures are so high, is an unusual situation. Policymakers are really scratching their heads to try and understand what is behind this, but it makes the labour markets tighter than they usually are. And it does mean that wage pressures are potentially greater than they usually are at this point. Hence, the very strong reaction that we're getting in terms of interest rates. Where are we now as far as the inflation picture is concerned? Well, if we look at consensus forecasts for inflation for this year, we can track how these changed over time. So these are polls that were taken all through last year, a little bit start of this year, of where people thought 2023 inflation would end up. And the expectations have broadly stabilized. So after a long period of time when people thought inflation would get higher and higher, now there has been some stabilization. That is good news. It's still not good enough news because, of course, we have stabilized at very high levels of inflation being expected for this year. So target inflation is still elusive. The US is much closer than Europe is to getting inflation back under control. The reason for that is simply that energy prices are less of an issue because natural gas in the US is far cheaper, being a much more closed internal domestic market than in Europe when natural gas is imported from other parts of the world. Where are we on policy rates? Well, given how much tightening has already taken place, and given that we are probably at the point where all of this can be expected to kick in, because it usually takes about 12 to 18 months or so before the peak impact of policy rates is being felt, we think policymakers are approaching the end of the current interest rate hikes. We're not quite there yet. We think that we'll get a couple more hikes in the US, probably a couple more hikes from the Bank of England as well. The ECB is a bit further behind, so there we think we will still get some more significant rate rises. But when it comes to around the middle of the year, perhaps a bit earlier in the US and the UK, we could see the long-awaited pause on interest rates as central banks try to evaluate whether what they've done so far is enough. Evidently, nobody wants to tighten policy more than necessary. The idea is simply to cool price pressures, and to a certain extent, there is, of course, a tolerance that might mean tolerating a recession. That may be a necessary condition to bring inflation pressures under control, but nobody wants to overdo it and cause more pain than is strictly necessary. So there will probably be a case of pausing before long. Eventually, we think we'll get to the point of rate cuts as that inflation picture improves sufficiently that sort of very tight monetary policy is no longer necessary. Markets seem to agree with us directionally in general. The bigger gap between our view in the market is perhaps as far as the UK is concerned, where we think that sort of reasoning will hold as well. Markets think much less by way of rate cuts is coming than we. Finally, on the growth side, for this year, yes, 2023 does still look like it to be a tough year. We don't want to understate this. And the reason why is simply we have had, as I showed, very, very substantial interest rate increases. These will affect the investment picture for companies. They will also filter through to households, also via the housing market. And of course, energy prices are still a big drag and are still a high part of the bill. There's more pass-through of that to come, which will make itself felt in terms of consumer spending power and in terms of business investment. So with that, we are still looking at a recession for this year. However, given that the energy price picture has improved, and given that in general, there is more hope that we're getting to a more sustainable point as far as interest rates are concerned, so not much more tightening is needed, that shouldn't be a very deep recession. We're looking at a relatively shallow recession, and by 2024, we think with the interest rates cuts that we're getting and with the energy picture improving, we could get to the point when rates are cut again and recovery is restarting. That is about it from me at this point.
Great stuff. Thanks, Sandra. Great presentation. Although I think you probably you've triggered our collective PTSD there by mentioning the mini budget, but we'll no, that's fine. I had to mention. Thanks so much. I'm going to ask John to come onto the virtual stage now. John, are you there?
I'm here. I think you have to release my video is the only thing, because I can't. Oh
gosh. Okay, I'm sure we can do that.
There we go. Thank you very much indeed.
Right.
There you
Excellent.
Are. You can see me now. Thank you very much.
Stuff.
Okay. Now, just to tell everyone, the technological glitches we're having beforehand were all me, basically, because I was struggling to do the screen sharing and at least make it in a way that made it acceptable. But I'm going to have another go now. So if I share my entire screen rather than the window, I'm hoping that I can get the presentation up, where it will show. There we go. Is that looking better?
Excellent. That's great. Fabulous.
Okay. I knew I could get there.
Over to you then, John. Thanks.
Okay. Thank you very much. And good evening, everybody. So I'm going to sort of keep this reasonably high level, and hopefully there'll be some Q&A at the end of it. The title of the talk is More Bumps in the Road. You probably feel we've seen quite a lot already. I'd say some of them are pretty big ones. They might be a little bit smaller this time around. But the good news, there is light at the end of the tunnel, I think, within all of this. And I want to leave you kind of with a message of being a little bit more upbeat, shall we say, certainly by the time we get through 2023, but might have to show a little bit of patience en route. Now, 2022 was very much a year to forget. I think the feeling is 2023 could be a game of two halves, where things could be a bit difficult in the first half of the year and then improve in the second half of the year. Although, interestingly, in the last few weeks, that view around the market is being tweaked a little bit, and an idea perhaps that economies and markets might be more resilient in the first half of the year, but then go worse in the second half of the year. So weirdly, you might end up kind of in exactly the same place in the end, but getting there by two very different routes. But we'll talk a little bit around that and what it all means. However, the first thing, and I'm sorry to sort of go back to sort of some parts of UK political history, but looking back at the autumn statement, and I just wanted to put this in. I had this in a presentation at the end of the last year, looking at a review of 2022, but there was one very specific thing that came out of it that I kind of wanted to go. So I'm not really that interested in the fiscal consolidation, but it was obviously a very good thing to do after the kind of spendthrift trust era, as it were. But it's more this point here, key points for investors. Two key points in particular: the reduction in the dividend allowance and the reduction in the capital gains tax allowance. Now, one thing that Sandra didn't necessarily speak about in the economic side, the UK has got an awful lot of debt at the moment, not only private sector debt, but especially public sector debt. And you may well have seen this morning, the public sector borrowing numbers came out. They were worse than expected. And one of the reasons for that is because interest rates are going up, and therefore just servicing the debt is going up more. So the government is kind of stuck in a way. How on earth do you get this debt down? And I've always thought in the past there are four ways of doing this. So the easy way out, if you want to put it that way, is to default on your debt. Well, as a kind of proper sovereign nation that prints its own currency, can raise its own taxes, and issues its debt in its own currency, not in somebody else's, then the chances of default for the UK are very, very slim. So I don't think that's going to happen. That's for if you import emerging market countries. The best way out of this would be productive growth. But given the experience of the last, let's say, 10, 20 years, we wouldn't bet the farm on that, although I'd like to think perhaps the sort of things that you're investing in could be the sort of investments for the future, which do actually spur productive growth. So let's not give up on it completely. And then the other two were austerity and financial repression. Now, austerity, I'd often thought was something that was kind of moving off the agenda in the last couple of the years. It wasn't very popular with the electorate. So, more cuts to public spending, that sort of stuff, not going down very well. And indeed, governments, not just in the UK, but around much of the Western world, suddenly found some welcome in spending more during the COVID pandemic. And then, as you've seen in some countries as well, some incentives for green investment and this sort of thing. So, that worked very well as long as interest rates were close to zero and bond yields were close to zero, so they could raise capital at very low costs. But as soon as interest rates started going up, as Kwasi Kwarteng discovered, if you start trying to give too much away, the bond vigilantes come galloping back into town and sell off your bond market and your currency quite aggressively. So actually, weirdly, I think austerity is sort of back on the political agenda again. And I also feel that if there are any other countries that try to do something as stupid as we do, they will be visited upon by the bond vigilantes very quickly as well. But the other one is this element of financial repression. Now, this is something which has been talked about for quite a long time. One of the ideas is that, for example, that you keep the interest rates or bond yields suppressed below the level of inflation. So effectively, you gradually inflate away the debt. Now, a gentleman called Russell Napier, who's a kind of market strategist and historian in particular, has often described financial repression as stealing money from old people slowly. So the idea being that savers have their money in savings products which have very low interest rates, whereas inflation is higher, and they don't really realize what's happening to them over quite a long period of time, and suddenly they discover that their buying power over many years has kind of disappeared. So that's one facet of it, and you can do that either by central bank intervention, which has been obviously the case with things like quantitative easing and repressing bond yields, but you could also do it by forcing financial institutions to buy certain financial assets. You say, well, I'm sorry, but Mr. Wealth Manager, we've decreed that everybody should have at least 20% of their portfolio in UK gilts, and that's just the way it's going to be. Not impossible that sort of thing could happen. It's already happened in some degrees in the insurance industry, where solvency has to be kept at a certain level, and you have to have a certain amount of your capital in safe government bonds. And similarly for the banking industry, with the massive recapitalization we've seen of that and much safer assets that they have to hold now relative to what they did before the financial crisis. But the other one here, which I just took from Investopedia, is measures by which governments channel funds from the private sector to themselves as a form of debt reduction. And if you go back to the previous slide, this is all part of it here. It's just making life harder for investors. So dividends get taxed higher. CGT allowances are cut. It's been cut from 12,000 a year this year to 6,000 next year to 3,000 a year after that, for example. And you've probably already noticed the fact that the lifetime allowance for pensions has been frozen for an awfully long time now. In real terms, that ceiling just gets closer and closer for investors. So I just wanted to kind of lay that out at the beginning as a mindset that one must have. If you look at government debts and how high they are, but if you look at all the contingent liabilities in terms of unfunded pensions and state health care and all that stuff that will have to be done, social care, there's still a huge liability there. And I would always urge anyone to max out as much as possible any current sort of tax sheltered investments they can have, particularly things like ISAs and SIPs, but obviously there are other kind of things in the venture area that you can do as well that may well already be doing. So that was that. Looking at it from a market perspective, I mean, again, how we got here in 2022. This is a slide of asset class performance across last year in sterling. So this is, all the equity markets around the world, all the bond markets across the world here, property sector here. And you can see this is the zero line. Pretty much everything is below the zero line. It was a nowhere to hide year in financial markets. What was above the line? Well, the UK, actually, equity market was okay. It was up 7% on the year. But the main reason for that, one of the reasons, was the fact that sterling was down 11% against the dollar, and an awful lot of dollar revenues and profits and dividends in the UK stock market. It also benefited from the fact that a big chunk of the index is in the energy sector, which had a very good year last year. For example, the Brent crude price up 55%. So, there were very, very few areas in which money could be made last year, certainly in traditional assets, and certainly anything like a 60-40 type portfolio. And I think one of the key points to make about last year is just what a dreadful year it was for the bond market. So it was the first global bond bear market for actually 7 decades. And if we take the Bloomberg Global Aggregate Index, which is just investment grade bonds all around the world, this just goes back to 1992, which is as far as my Bloomberg would allow me to go back. But from the peak of this market in early 2021 to the trough, which is around about September, October of last year, it was down 24%. And certainly, if you'd gone further out down the duration curve, if you were looking at sort of gilts with 40 or 50 years to maturity, they lost more than half of their money during that period, or half of their capital value. And of course, with very little in the way of yield to help you out, it wasn't as if you were getting compensated by at least getting some income while this was going on. So it's a catastrophic year for bond investors. And for a 60-40 portfolio, which is kind of like the guts of an awful lot of investment strategies around the world. I've taken this for the US, looking at the S&P 500 and its precursors, and the US 10-year Treasury yield on a total return basis going back to 1928. So I've looked at it, I borrowed it from this gentleman who posted this stuff on the web. But what you can see here in these yellow boxes, there are only 4 periods in the last 100 years where both bonds and equities had made negative returns in the same year. So 1931, which was obviously during the period coming out of the, going into the Depression and after the big crash in Wall Street. 1941, as we embarked on the Second World War. 1969, which was coming into the the inflationary period of the 1970s, but also coming off a very high valuation point for equities. And then, even though it did happen sort of in 2018, it was marginal. But this is a doozy here, it's fair to say. The fact that the S&P 500 was down 18% on a total return basis, the 10-year, this is the 7 to 10-year bond ETF was down 15%, giving you an almost 17% negative total return on a 60-40 portfolio. And you can go back through all of these numbers here. The only number that was worse was in 1931. So it was one for the ages, I think it's fair to say, which is why a lot of people are in shock at this particular point, it's fair to say. And there was just no balance in the portfolio at all. So even if you go back to the financial crisis, at least you could have said, okay, equities are doing really badly. They were down 37% last year, but you could have made a lot of money in bonds. So at least you had the option of going into a different asset class to try to help you out. And I think that, the key point about this is this correlation between bonds and equities. So this chart goes back to 1930. It shows the rolling 5-year correlation between bonds and equities over that period. And it also shows if I could get this off here, move that down, it shows the year-on-year rate of inflation as well. And what's clear from this is that when inflation is relatively low, you tend to get a more negatively correlated environment. But when inflation starts to rise again, particularly from very low levels, you tend to get a more positively correlated environment. Now, because this is a 5-year rolling chart. It doesn't necessarily show it in quite the same way, but the next one here gives you some short-term correlations, and you can see them shooting up here on this blue line. So that was the problem. It's the correlation between equities and bonds. You might have heard people talking recently about, is this the death of the 60-40 portfolio? Well, not necessarily, I think, is the case. But I think if we are entering potentially a world in which inflation is going to be residually somewhat higher and possibly more volatile than it's been in the past, for various of the reasons that Sandra was talking about, then we may actually find ourselves sort of toggling in and out of positive and negative correlations between bonds and equities, and it'll put a much bigger premium on tactical asset allocation within balanced portfolios. Now, the reason for it, so Sandra obviously showed you this in a different form, but I quite like this graphic. So this is the overnight interest swap curve for US rates. The yellow line on the bottom is where it was on the 1st of January 2022. The green line is where it was yesterday afternoon. And so if you look at what the expectations were here, so if you go to roughly the 1-year level, which would have been about here, a year ago, the market was saying that US interest rates would currently be just under 0.5%. Where are they now? 4.5%. That is a massive gap of a reset of expectations. And, if you take the view that happiness is the difference, is reality minus expectations, well, reality in this case is kind of, reality is so high relative to expectations, but it's the wrong way, I guess. So maybe it should be expectations minus reality. In this case, you turn the equation around. So this really was the main factor behind the problem in markets last year. Yes, it was the fact that they moved this far, but it was like the shock in terms of expectations and the speed at which they moved. So the markets had to make a massive adjustment. And this is the UK, so it's a similar thing. The Bank of England already started its rate rising cycle by the end of 2021. But even, as I say, a year ago, the market expected rates to be 0.75% now, and they're actually 3.5%. And they've got further to go as well. The market still thinks they're going to go up somewhere close to 4.5 at this particular time. Again, in terms of what happened last year, this is rising global inflation expectations. Started the year at 3.5, ended up at 7.5. So that's a big shift. Go out to 2023, they're still pitched at 5, just over 5% for this year. And even if you go to 2024, well, they're coming back. And this is, I guess, the good news is that there's an element of disinflation here. We've seen the peak in inflation, but I think I would also emphasize that if you kind of compound 7.5 and then 5 and then 3, you're up around about 17% of the total kind of pricing level. And the problem with that is that wages are definitely not up 17%. So from a real income perspective, the consumers are still struggling. We think that's still going to be a problem as you go through this year. From a market perspective, one of the key things that did happen here, because you had this big repricing of rates, and particularly at the longer end of the yield curve, you saw the rate shock feeding through to this massive underperformance of growth stocks against value stocks. So growth stocks is high quality stocks which are going to churn out things way into the future with a lot of certainty, but it's also things which on the growth, and particularly the more speculative growth side, which don't make any profits today, and which their valuation was based on profits they're going to make a long time into the future, hopefully. That's the stuff that's really been murdered. So the kind of big flag bearer for this in the US has been Cathie Wood's ARK Innovation Fund, for example. Individual stocks like Tesla, Netflix, Peloton, Zoom, whose product we are using now, for example. And there's had to be a massive recalibration, I think, of two things: not just the discount rate effect on the net present value, but also actually the profitability and the ability of these more speculative companies actually to ever get into profits, possibly before they run out of money, which is very much a kind of rerun of the tech boom and bust of 2000. So, there's a big wedge opened up here. So the MSCI World Value since the beginning of last year, it is down, but only like 3%, whereas MSCI World Growth is down around about 25%. So this is a big hit for growth investors in particular over this period. You may well have read Terry Smith of Fundsmith. He put out his annual letter last week, and if you haven't read it, it's worth just searching out for it. He'll be on his website. Just Google it easily, and his explanation for why he fared so badly, and the fact that he still thinks the companies that he owns are very high quality and still making great returns on capital relative to their cost of capital, and will still compound value over a long period of time, which is very much what we believe about a lot of the stuff that we own as well. I think one key thing to make is the difference in volatility between prices and dividends. I always try to remind people of this. So the blue line at the top is the volatility, annualized volatility of the FTSE All Share. The purple line at the bottom is the volatility of dividends. And so certainly if you're in a sort of more income seeking strategy, in fact, you'll have seen over the last year that FTSE, dividends have actually gone up quite a lot more than the market over that period, and particularly over the last couple of years. Just looking at the market as it sort of currently stands, I mean, looking at the Bank of America Fund Managers Survey, the latest one that just came out for the end of December, beginning of January, Sandra was talking about recessions, and certainly, you can see that the recession fears peaked here in November 2022. And in terms of the percentage of people expecting a recession, it was not a million miles away from the sort of depths of the COVID crisis or the financial crisis. So sentiment was pretty poor, really. And so to that degree, people have talked about this as being the most anticipated recession in history. I'm not quite sure I'd agree with that, but certainly well anticipated, I think it's fair to say. But interestingly, just over the last sort of few weeks, that has now turned down a little bit, and talk a little bit about why that. Well, Sandra's already mentioned it to some degree as well. And the other thing is, strategists are unusually bearish. It's very rare that Wall Street strategists expect the S&P 500, for example, to be down on the year. In fact, this is the first time ever since Bloomberg started doing this survey in 1999 that the expectation is for the market to be down this year. So you could say the good news is that expectations are very low as we move into 2023. Having said that, we still think there are headwinds in front of us. One is slowing growth, and that's really the effect coming through, the lagged effect of higher interest rates and how they leak their way through the economy. From a liquidity perspective, interest rates are still going to go higher. I mentioned the UK there, the market's sniffing out 4.5% as the peak. In the US, it's going to be around about 5%. The ECB is talking very much about as potentially another 250 basis point interest rates hike, that will take them to 3.5 as well. So there's still more to come in terms of the actual kind of tightening of day-to-day money, as it were. Also, central banks are reducing the size of their balance sheet, so we've gone from quantitative easing to quantitative tightening. As there's the refinancing risk, so as maturing debt rolls over, you have to refinance at a higher level, and also we've seen quite a big constriction of money supply as well. So that's another thing which seems to suggest we've got headwinds in front of us. Is there going to be a recession? I mean, I kind of think the UK is already, if not in one, very close to one. It looked like the last GDP numbers that came out for November were a little bit better than expected. We'll have to see for December, but I mean, we're kind of splitting hairs here about whether we're in a recession or not. The economy is, very flat at the moment, and I think there's still worse to come as these effects come working through. The EU has definitely got away without the worst because of that fall in the energy prices, and I think what we've seen in the European stock markets in the last couple of months is what I'd call pricing out left tail risk. So effectively, the market was priced for a very deep recession, from shortages of energy, from the potential for having to, ration energy, particularly into the industrial sector, this sort of stuff. And we've moved away from that now. And the warm weather has definitely helped as well on that particular front. So that's an act of God in our favour, as it were. The US remains the big question. It's been interesting in the last few days. Big investment banks such as Goldman Sachs and JP Morgan have both come out and said we don't think there's going to be a US recession. Even if there was one, we thought it was going to be a relatively shallow one anyway. But I think the next thing is the earnings position, and I think what we're still concerned about is that if you start getting a bit of sort of disinflation coming through, it doesn't make it as easy for companies to raise prices as they were doing last year. But some of those lagged cost effects coming through, particularly of wages, will impinge on margins. So we still think there's a bit of a kind of recalibrating of earnings to come through. And in terms of the recession, I mean, if you just look at what the market's telling you, this is the 3-month to 10-year yield curve. So it's basically the difference between 3-month rates and 10-year rates. So this is the US yield curve. So currently 10-year rates are 114 basis points lower than 3-month rates. Now, this is basically the market telling you that there's, the Fed is being too aggressive on its tightening, and that well, something's going to go wrong effectively. And every time it's been down here before, running into COVID, before the financial crisis, and the kind of tech bust recession of the early 2000s, and there are times earlier than this as well. But every time this 3-month, 10-year yield curve has been in such a big inverted state, there's always been a recession. Now, it could be different this time. As we know, the most kind of dangerous words in financials are this time is different. But this is telling us certainly to be on our mettle and looking out for potential recession in the US and what that would mean for earnings. Just in terms of how we sort of approach this in portfolios, what we have, we've moved to be below benchmark in terms of our equity allocations in terms of risk. We've been starting to sort of pick up a little bit of risk in the last 6 months as we saw better value in the market, but we're not certainly back up to neutral, yes, and we're definitely not overweight. But we are overweight in fixed income assets, where we actually thought that when bond yields went up quite sharply, they gave something a better counterweight in portfolios. We're overweight in alternative assets, and I think again, when one's thinking about the longer term sort of allocation across asset classes, when you get into that stage as we did last year, where neither bonds or equities are going to help you, you've got to have something else as a risk diversifier in the portfolio. And one of the key areas that we put money into was uncorrelated hedge fund kind of buckets, basically, where we could see the potential for making idiosyncratic returns, which actually worked out very well in that environment. So I think you're going to have to think about being kind of more creative in the portfolio allocation process over the next few years than one has been over the last 10, 20 or even 40 years, to be honest with you. That's our current tactical asset allocation tilts in a little bit more granularity. But I just want to move back now to something a little bit more on the bright side. So the one good thing that has come out of the last year, of all asset classes pretty much losing value, particularly the key bonds and equities, is that the future returns potential has gone up. So I've taken this from JP Morgan's long-term capital market assumptions, which again, you can Google this and find it publicly available on the internet. But what you see is, between the beginning of 2020, well, sort of Q4 2021, effectively in Q4 2022, expected returns on US large caps went from 4 to almost 8%, UK 5 to 9. It's up pretty much across all the different asset classes. Now, if you're an investor still in the accumulating stage of your pension or whatever, you should be running laps and cheering, because of this. You should, the volatility of last year makes no difference whatsoever. If you've got a long investment horizon and you're still accumulating, this is brilliant news. As Warren Buffett says, when hamburgers are cheaper, we all rejoice in my house. And hamburgers, in this case, metaphorically, were definitely cheaper over the last 12 months. And this is, again, across all the different sort of asset classes. So whether it's, this is a massive jump in aggregate bond returns from just over 2 to just over 4, for example, there for US aggregate bonds. Private equity, that's gone up a bit. Interestingly, the one that hasn't is core real estate. And I think a lot of that has to do with shifts in the utilization of real estate, the shift to, working from home, and certainly some of the onus for expenditure on making property greener, for example. So there's some interesting kind of wrinkles within that. Last thing I'll say is a word on China. Definitely things have changed an awful lot in the last kind of 20 years in China. So this was just from taking key words from the National Party Congress speeches. So back in 1997, it was all about this big green box at the bottom here, the economy, markets reforming and opening up. But over time, particularly under Xi Jinping, that has gone down. Very little of it here, and much more on security, military and defense, socialism, a big shift in emphasis, as it were. But having said that, this may well have marked the nadir sentiment towards China, because we were thinking, could it get any worse? There was a Financial Times Lex column, and this is usually a very good sign, actually, on the 29th of November, asking the question is whether the Chinese market as a whole is becoming uninvestable. Well, if you'd bought Chinese assets on the day that was printed, you'd be up about 30% now. So I thought that was quite interesting. And if you look at all of these things here, the zero COVID policy, they did a massive U-turn on that. They're providing more liquidity into the real estate sector. Yeah, dreadful demographics. That's a difficult one. You probably saw last week the news that the population growth was the lowest. Well, it's gone backwards actually, first time since 1961, for example. So there were a lot of super negatives in terms of sentiment, and we still think there's probably some decent bounce to come as far as China is concerned. So key messages to leave you with. We're still in a bear market cycle, we think, but we're definitely moving from the end of the beginning to the beginning of the end, if I can be a bit Churchillian about that. Tina, there is no alternative. That was in the days of very low interest rates and very low returns on bonds. Gives way to Tara, there are reasonable alternatives, which means you can get some decent returns from fixed income now. So you don't have to have as much risk in portfolios necessarily if you don't want to. We've always said, we're cautious, not fearful. We're trying to keep people in the market, as it were. And I still think there's a lower probability of some sort of systemic financial crisis. People still very much anchored to the great financial crisis. But, a lot of the risks are not in the banking system necessarily at the moment either. And the banking system itself is much better capitalized than it was and much better regulated back then. So we're looking to increase our equity and credit weightings as we move through this year. Waiting to see what the resilience of the corporate earnings cycle will be, where inflation, and we actually think the inflation cycle has peaked now. Actually, we're just waiting for the rate cycle to peak, just remind ourselves that bull markets always follow bear markets, and I think that's a good place to leave it. I hope I haven't gone on too long.
That's great, thanks, John. Gosh, there's a lot to take in there, a lot. Actually, Sandra, if you could rejoin the stage, that'd be grand. We are more or less out of time, but I'd like to, I'm gonna, if it's all right with you guys, stay on the line for a few more minutes, and just in case anyone has any more questions. But we did have some in already, which I'd like to touch on. Sandra, this is one for you, well, actually possibly for you both, but and two linked questions really, which is, so you touched on the labour market and wages, and of course one thing we're facing in the UK right now is a whole array of strikes. As a child of the 70s, I keep thinking this is at least going to lead to some good music, but so far as I can see, that's not happening. But maybe I'm just old. But so it'd be good to, I'd like you to comment on what potential impact of the strikes is on the economy, but also linked to that in terms of political instability. And of course, this is a family-friendly show, so we don't do party politics. But we have got a government that is something like 12 to 20 points behind in the polls. So very, very possibly a significant change in government for the first time in 15 years coming down the line in 18 months. It'd be interesting. So just general instability around the political environment, strikes. It'd be great to get your sense of what the potential impact there is, economically speaking.
Yeah, I think from the strikes perspective, the direct impact of the strike so far is still nothing like the 70s. I'm pleased to reassure you on that one. I think we also have to learn that certain things like rail strikes, etc., are to some extent we are adapting to these. We have mitigations. Working from home means that the rail strike doesn't have the same impact, even if the same number of rail workers are striking as they were beforehand, and so on. So the direct impacts may not be so large, but certainly they're not negligible either. I think the healthcare system is one concern in particular, because it's not clear to what extent that weakness in labour market participation is actually a reflection of the state of the health system in the UK. So anything that makes it worse could have some longer term repercussions there. As far as all of this is, of course, in the context of the very tight labour market. And so an easy resolution, unfortunately, doesn't seem to be in sight, with the government coffers still struggling. Which leads me on to your second part of the question. Government coffers will be in a difficult state no matter which government it happens to be going forward. So we have to take that into account going forward. We can't expect much help from that side. John talked about financial repression and other mechanisms in which governments will have to rebalance the books. And I think that will be a theme that will be with us for some time to come, no matter who takes over.
Okay, that's great. Thanks, Sandra. And John, question for you. Just obviously bearing in mind that the bulk of the people on the line are actually, I'm sure they're investing in many different ways, but obviously are on the line because they are angel investors. Have you got any? I mean, you talked right at the beginning of your talk about the fact that hopefully our kind of investors are driving productivity more generally, because God knows we all need help there, right? But have you got any thoughts on the sort of sectors that, I'm sorry to put you on the spot on this, but the sort of sectors that might be looking interesting for angels at this point?
Well, I mean, the obvious one to say, anything to do with the energy transition, really. I mean, we've had a massive loss in the last week or so, where the British Volt Kicker battery factory up in Blythe has basically gone into liquidation, or any hopes of that happening. It's just a big chunk of land with nothing on it now. And I don't want to get dragged too much into politics, but unfortunately, within that, you have to say that part of the problem has to be Brexit, because if you make batteries in this country, they can't make it very easily out of this country, if that's the case. So we're seeing that car manufacturers, for example, want to buy stuff which they can move around a lot more easily. So that's a difficult one, but the opportunity is definitely there, I think, within the green energy space and within the energy transition space. But as ever with hot sectors, it's getting into the right technology at the right price, and obviously you've got to be the judges of what that is. I think if you look back to the beginning of last year, certainly within the public markets, you could see a massive run up in the green energy space. A lot of it is through ETFs and funds and stuff like that. And at the time we were looking at it and thinking, hang on a minute, this does smell a bit like a bubble. Indeed, these things have come back a hell of a long way. Look at kind of stocks related to hydrogen industry, for example. It may well be, and it really should be, that some of these will do exceptionally well over a longer period of time. And actually, if you look back to the experience of the tech bust in 2000, it was one of those ones where everything went up an awfully long way and everything came down an awfully long way, but it's the ones who actually get through that and survive and have sufficient capital to develop some decent businesses where actually you could really see a really long runway of growth and returns in front of you. So I think it's trying to sort of pick those survivors out. So I think that's one area certainly that I'd be interested in. And from a productivity point of view, I mean, it's any kind of, it's either hardware or software really, which manages to to attenuate the problems in the labour market. If there's a shortage of labour, if you can find a way of making one person do more stuff. Now, I don't know what it's like, all around the country, for example, but I certainly know, here in London, quite often these days, I will, go to a restaurant and you don't see a waitress or a waiter. You basically you do a QR code on your iPhone, and you put your stuff into there, and the food magically appears. So there are definitely interesting things like that, which I think will increase productivity, and it's particularly for the lower paid jobs, which is, I think, is where people are really struggling to, we definitely had a shift in people's mindsets, and I think COVID did wake a lot of people up and saying, why am I doing this shitty job for so little money, as it were. So anything that gets shitty jobs done more easily is got to be.
Well, actually, it's interesting you say that, because actually I was just about to wrap, but Jodie has snuck in with a last-minute question, which I think possibly relates to shitty little jobs, which is any thoughts about the impacts of ChatGPT or indeed generative AI in general? And that's obviously to both of you.
Yeah, I mean, it's a real thing, and we've already seen, for example, I believe that ChatGPT was allowed to take some medical exams and pass them, so it can be a doctor now. But having said that, we also know that AI-led sort of machinery or whatever, diagnostics is more accurate than human diagnostics. For example, if you show it a mole, and take a photograph of it and put it into the machine, it will tell you more accurately whether or not you've got some form of skin cancer than a doctor will, because it's just got that whole reference base to go through. So I think you don't think it necessarily in terms of replacing, you think of it in terms of kind of being an adjunct to current skills. I think that what we've seen so far is very clever, but it's kind of hyped up Google, as it were. It's a search, and it's very clever, and it looks very clever, but actually you look at it and all it is it's kind of those slightly dodgy kind of précis that you used to do at school, when you thought if you basically had an essay to write, and you went to the library and got 4 different books and took a little bit out of all of them and tried to make it look like your own work, you were being rather clever. I don't think we've got a lot further than that at this particular stage, but the next iteration up, could be very interesting. But again, I think it's taking sort of drudgery tasks out of it. But from my perspective at any rate, I still think you need subjectivity and proper experience, and to be able to relate to human psychology and emotions and all that sort of stuff, which I don't think a chatbot or whatever is quite yet ready to do.
Okay, that's great. Well, look, we really better had wrap it there, but thank you so much, John and Sandra. Really fascinating session. I'm just going to wrap up actually with a few next steps, but great to see you both, and thank you so much again for your time. Let me just bring my screen up. So just a few next steps. If you'd like to get in touch with Investec, please do so through Hannah Goody, whose email address is there. If you haven't already joined us as an investor, please do so at our website. And if you're a founder and on the line and would like to apply to pitch to us, again, please do so at the website. And then finally, we're available all the usual social media places. We're particularly active on LinkedIn. We have a monthly newsletter that goes out on Substack. Tonight's session will actually be edited and put up on YouTube, along with a lot of other fascinating videos, including all the previous Investec economic updates. And we blog regularly on Medium. And just a word to say that we do have our first pitch event of 2023 next Tuesday. So if you've got any questions about that, please drop us a line. But once again, thank you all for your time. Thanks to John and Sandra for their amazing insights. And hopefully we'll see you all soon. Okay, thanks everyone.